Ladies and gentlemen, welcome. I thought it would be a good idea to make this video and to explain to you why price-based indicators do not work. So that means 99% of indicators out there which people use. Let's start with a classic case, the moving averages, and trying to trade moving average crosses like here. The faster one goes below the slower one, so that would be a short trade. Okay, and here it would have worked. Or here. What's the problem with this? Of course, you can cherry pick situations where those crosses were indicative of a coming move. But then this here is a problem. If you do not trade those crosses, you will not be in the one which actually will work eventually, like this one. But here you get whipsawed. 1, 2, 3, 4, 5, 6 crosses. This will take away any pips that were made in a cross which actually worked. And of course, we can see those whipsawing phases on a regular basis. Otherwise, it would be easy. So do not fall victim to this, okay? Do not just look at the situations where it worked and ignore the large sample and the situations where it didn't work at all. Why? Because obviously, first of all, any moving averages crosses will be lagging. So you see the price goes down here and here comes the cross, and just when the cross comes, the price reverts to the other side again. So lagging is one problem. The second problem is whipsawing. Yeah, where you have multiple bad entries one after another, and people underestimate the losses they make in a consolidation zone like here, because those losses will be far greater than those pips gained on the moving average crosses which actually worked in the end. This is a beginner's mistake. If you're new to Forex, you experiment with those kind of approaches and you will quickly realize it doesn't work. Otherwise it would be easy. I could show a lot of tools. I picked this reversal indicator. You'll find many of those for free on the internet. And look, of course you find situations where you have good signals, like this long signal here, okay, and this short signal here. Those moves actually worked, but the same problem is there. This particular one is not repainting, but you also have whipsawing, but in a different way. When it's a reversal indicator, often you have a period where the multiple losing entries, okay, right after one another, like here. And the same thing applies, as I've said before. If you want to catch one of those signals, you will also trade the false signals. And even if you filter some of the false signals out, the problem is there in a similar manner. People underestimate the accumulated losses from bad signals. Okay, and they don't understand that filtering is not the solution. And then, last but not least, if you try some kind of breakout indicator like here, let's say trend line break, the same thing applies again. Of course, eventually you have a good signal somewhere where there was a breakout and a move followed, but you have a lot of wrong signals, okay? Like here, 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 etc. And then, of course, you have indicators which are repainting, so they look perfect in hindsight, but live they give you very bad signals. So those approaches are not working, especially if you test them properly with different conditions over a longer time period. You will see that those approaches will fail. The market manipulation is so efficient that they take into account those kind of attempts to trade the markets, and they will on a regular basis switch between different market phases, and that alone will just destroy those simple approaches to the market. Okay, that is the reason why we use the market causality. The market causality represents leading information, okay? It represents the actual market in front of your eyes, visualized, okay? You see where the dump money positions are, where the stops are, etc. That is why the market moves like it does. Those approaches here are pretty much useless.